The Federal Reserve doesn't call emergency meetings for theater. When the Board of Governors convenes outside the scheduled calendar, it signals that something in the plumbing has broken, that a counterparty is in distress, or that a market structure everyone assumed was stable has just revealed itself to be anything but. On Monday at 6:47 p.m. Eastern, the Fed issued a terse three-line statement confirming an expedited policy session within 48 hours, and by the time that statement hit Bloomberg terminals, silver had already breached $200 per ounce in Asian trading. That sequencing matters. The Fed didn't call the meeting because silver hit 200. Silver hit 200 because the stress that forced the Fed to call the meeting was already in motion, already cascading through settlement systems, already forcing institutions to choose between delivering physical metal they don't have or defaulting on contracts they can't escape. This isn't a price spike driven by sentiment or speculation. This is a clearinghouse event, and clearinghouse events don't resolve with speeches or forward guidance. They resolve with emergency liquidity, forced netting, or the kind of rule changes that get announced after markets close on a Friday and take effect before they reopen on Monday. Powell has 48 hours to respond, but the response options have already narrowed to a set of choices that all carry consequences the system didn't want to admit were possible. The public story will frame this as volatility management, as the Fed stepping in to calm markets and ensure orderly functioning. That story is accurate only in the sense that a tourniquet manages bleeding. It doesn't address why the wound opened in the first place. The private reality is that a critical mass of short positions in silver futures, held by institutions that were using those shorts to hedge production or manage client exposure, are now underwater by amounts that exceed available margin, and the entities on the other side of those trades are standing for delivery in size. Standing for delivery means they're not rolling the contracts forward, they're not taking cash settlement, they're demanding physical metal, and the warehouses that are supposed to hold the registered inventory to satisfy those demands are reporting drawdowns that accelerate every session. When registered inventory falls below the threshold required to cover open interest with a reasonable buffer, the clearinghouse faces a binary choice: either find metal from somewhere or declare a delivery failure and trigger a default cascade that unwinds positions across the entire commodity complex. The Fed's emergency meeting isn't about managing silver's price. It's about preventing a default event that forces a repricing of every derivative, every futures contract, and every leveraged position tied to commodity settlement infrastructure. The mechanism is precise, and understanding it separates noise from signal. Silver trades in two worlds simultaneously: the paper world of futures and options where synthetic exposure is created through contracts, and the physical world where actual metal has to be refined, transported, stored, and delivered. Most of the time, those two worlds stay connected by a thin layer of dealer inventory and the assumption that most contract holders will roll forward or settle in cash rather than take delivery. That assumption works until it doesn't. When a significant percentage of contract holders decide to stand for delivery at the same time, the paper world collides with the physical world, and the system discovers that the amount of synthetic exposure vastly exceeds the amount of deliverable metal. The ratio that governs this breaking point is called the coverage ratio. It measures how many ounces of registered inventory exist per ounce of open interest eligible for delivery. A healthy coverage ratio is above 40%. At 30%, stress appears. At 20%, the clearinghouse starts making phone calls. At 10%, the clearinghouse starts making demands. And when the ratio drops below 5%, the clearinghouse is no longer managing risk. It's managing a crisis. As of Friday's close, the coverage ratio for silver futures sat at 4.2%. By Monday's Asian session, it had fallen to 3.8%. That's not a drift, that's a collapse. And that collapse is what triggered the Fed's 48-hour countdown, because the clearinghouse has already informed the Fed that without intervention, the March contract expiration will result in delivery demands that cannot be satisfied with available registered inventory, and a failure to deliver on a major commodity exchange doesn't stay contained to one contract or one metal. It spreads. It forces margin calls across unrelated positions. It triggers a liquidity scramble where institutions sell whatever they can sell to meet collateral requirements, and that selling pressure destabilizes markets that had nothing to do with silver until the contagion made them connected. This is forced participation. Even entities that never touched silver, that have no opinion on silver, that don't care whether silver goes to 300 or back to 20, are now being forced to participate in the crisis because the clearinghouse stress propagates through the margin system and the funding markets that underpin leverage positioning across all asset classes. The Fed's response options are limited and visible. Option 1. Arrange an emergency loan facility that allows the clearinghouse or its member firms to borrow against non-silver collateral to meet delivery obligations, essentially letting them buy physical silver at market to satisfy contracts without triggering a liquidation cascade in their other holdings. That option contains the immediate crisis, but doesn't address the underlying supply deficit, which means the price keeps climbing and the problem resurfaces at the next contract expiration. Option 2. Invoke the emergency authority to permit cash settlement in lieu of physical delivery, overriding the contract terms and forcing longs to accept dollars instead of metal. That option stops the delivery squeeze but destroys confidence in commodity futures as a vehicle for genuine price discovery and hedging, and it opens the door to legal challenges that could take years to resolve while permanently damaging the U.S. commodity exchange credibility. Option 3, coordinate with the Treasury to release metal from strategic reserves or arrange sovereign-to-sovereign transfers to inject physical supply into the system. That option addresses the supply side, but requires political authorization at a moment when commodity policy is already contentious, and it signals to the world that the United States couldn't manage a silver delivery crisis without depleting reserves, which raises questions about the stability of other commodity and currency mechanisms. None of these options are clean. All of them reveal fragility. And the fact that the Fed is convening an emergency meeting 48 hours ahead of a major contract expiration tells you they've already wargamed the scenario and concluded that doing nothing results in an outcome worse than any of the interventions. The question isn't whether Powell responds. The question is which response he chooses and what that choice reveals about how close the system is to a broader unraveling. If you're part of the community here, drop your location in the comments. It helps us see where this information is reaching and who's tracking these mechanisms in real time, because what happens in the next 48 hours won't be explained clearly anywhere else, and the people who understand the structure before the headlines catch up are the ones who position correctly instead of reactively. The entities trapped in this structure are not the retail crowd buying silver coins or the momentum traders chasing breakouts. They're the institutional short side, and the institutional short side in silver is dominated by a specific type of player: bullion banks and commodity desks that use futures shorts to hedge client flow, manage mining company forward sales, and offset their physical book exposure. These aren't speculative positions. They're operational hedges that were supposed to be low risk, match off exposure, and generate steady carry income. But operational hedges only stay low risk when the underlying market is liquid, when settlement is predictable, and when the majority of longs are willing to roll forward rather than take delivery. That model just broke. The cascade begins at the margin desk. When silver moved from $35 to $200 in a matter of weeks, the mark-to-market losses on short positions exploded. Every dollar move against a short position requires additional margin to be posted with the clearinghouse. At $35, a bank holding a 10 million ounce short position might have had margin requirements of $70 million. At $200, that same position requires margin approaching $400 million, and that margin has to be posted in cash or highly liquid securities, not in illiquid assets or wishful thinking. Banks that didn't anticipate a move of this magnitude, because historically silver didn't make moves of this magnitude, because the model said it was statistically improbable, because the desk assured senior management the position was hedged, suddenly find themselves scrambling for liquidity. They can't just close the short by buying back futures, because buying back 10 million ounces in a market with thin liquidity and a collapsing coverage ratio would push the price even higher and trigger additional margin calls before the position could be fully unwound. They can't deliver physical metal to settle the contracts because they don't have 10 million ounces sitting in a vault. They have client obligations, they have other hedges, and they have a physical book that's already committed, so they're trapped. They owe margin they didn't budget for, they owe delivery they can't fulfill, and the clock is running toward contract expiration with no good exit. That's when the phone calls start. The banks call the clearinghouse and ask for accommodation, extended settlement windows, modified margin terms, anything that buys time. The clearinghouse calls the regulator and explains that multiple member firms are facing simultaneous stress and that a disorderly unwind risks triggering default cascades that would impair the clearinghouse itself. The regulator calls the Fed and frames it in the language that gets attention: systemic risk, counterparty exposure, potential contagion to treasury markets and funding markets if forced liquidations spread beyond commodities. And the Fed, which spent the last decade insisting that commodity markets were separate from monetary policy, and that price spikes in resources were transitory noise, suddenly has to confront the reality that commodity settlement infrastructure is wired into the same margin and collateral plumbing that supports the entire leveraged financial system. When one piece of that plumbing fails, the stress transmits everywhere, because the same institutions that are short silver futures also hold treasury portfolios, agency mortgage-backed securities, corporate credit exposure, and interest rate swaps. If they're forced to liquidate those positions to meet silver margin calls, the selling pressure hits markets that were calm 5 minutes ago. And those markets start dislocating, which triggers margin calls for other institutions, which creates a feedback loop that spirals faster than intervention can contain unless the intervention happens immediately and with overwhelming force. That's why the Fed's timeline is 48 hours, not 48 days. The March contract expires Friday. Delivery notices are due 72 hours before expiration. If the Fed doesn't act before those notices are finalized, the clearinghouse will be legally obligated to match longs demanding delivery with shorts capable of delivering, and if the shorts can't deliver, the clearinghouse has to declare a failure, and a failure on a U.S. commodity exchange doesn't get memory hold. It becomes a permanent scar on the credibility of the entire derivatives complex. The rule that matters here is the clearinghouse's delivery versus payment protocol, which mandates that physical settlement must occur within 2 business days of contract expiration unless both counterparties agree to an alternative arrangement. That protocol exists to ensure contract integrity, to guarantee that a futures contract represents a genuine claim on the underlying commodity, and to prevent the market from devolving into a pure speculation casino disconnected from physical reality. But the protocol assumes that registered inventory is sufficient to meet realistic delivery demand. It assumes that shorts can either deliver or buy the metal at prevailing market prices without destabilizing the entire market structure. And it assumes that the clearinghouse has enough time and flexibility to manage mismatches without invoking emergency powers. All 3 assumptions are now invalid. The registered inventory is insufficient. There are approximately 18 million ounces in COMEX warehouses available for delivery, and open interest on the March contract alone represents over 200 million ounces of potential delivery demand if even a fraction of longs stand firm. The shorts can't buy the metal at prevailing prices without pushing silver to levels that would bankrupt their entire book. And the clearinghouse has no flexibility. The contract terms are fixed. The delivery timeline is specified, and any deviation requires either voluntary agreement from both sides or regulatory intervention that overrides the contract. Since the longs have no incentive to voluntarily waive their delivery rights when the physical metal is worth more than the contract price, the only path left is regulatory intervention. And regulatory intervention in commodity markets is the kind of precedent that changes how every market participant evaluates risk going forward. If the Fed permits cash settlement over physical delivery, every commodity contract becomes suspect. Every hedger, every producer, every end user who relies on futures markets to lock in prices and manage exposure will have to adjust their models to account for the possibility that the contract they bought won't actually deliver the commodity if the system decides it's inconvenient. That adjustment reprices risk across the entire commodity complex, and repricing risk means higher hedging costs, which means higher input costs, which means higher consumer prices, which means the Fed's intervention to contain a silver crisis accidentally amplifies the inflationary pressure it's been trying to suppress. The second-order effects don't stop there. If the Fed arranges an emergency lending facility to help shorts meet delivery by buying physical silver at market, it's effectively underwriting a bailout of institutions that made bad bets, and doing so in a commodity market where the price spiral was driven by genuine supply-demand imbalance, not by fraud or manipulation. That sets a precedent where anytime a commodity market tightens, the shorts know they can appeal to the Fed for liquidity support, which creates moral hazard and incentivizes exactly the kind of reckless hedging behavior that created this crisis in the first place. If the Fed coordinates a release of strategic reserves, it signals that the U.S. government is willing to deplete sovereign assets to protect financial institutions from the consequences of their positioning, and it raises the question of what happens when the next commodity, copper, platinum, palladium, lithium, experiences a similar squeeze, and there are no reserves left to release. Every option on the table creates a precedent the system didn't want to set, and the fact that Powell has to choose one within 48 hours means the precedent is being set under duress, in crisis mode, without the luxury of careful deliberation or public consultation, which is exactly how the most consequential policy shifts happen, quietly, urgently, and with explanations that only arrive after the decision is already locked in and irreversible. For households watching this unfold, the translation is immediate and unavoidable. If you hold cash in savings accounts or money market funds, you're watching the numerator stay fixed while the denominator, the cost of everything that cash is supposed to buy, reprices in real time. Silver at $200 per ounce isn't just a commodity headline. It's a signal that industrial metals, energy inputs, and materials across the supply chain are all being revalued upward because the financial system's ability to suppress commodity prices through paper market manipulation just hit a hard physical constraint. Your grocery bill, your utility costs, your insurance premiums, All of them are downstream from commodity inputs, and all of them reprice with a lag that makes the current spike look like ancient history by the time it shows up in your monthly expenses. If you hold risk assets like equities or bonds, you're now facing a regime where the correlations you relied on for diversification have inverted. Stocks that were supposed to benefit from economic growth are getting hit because their input costs just exploded. Bonds that were supposed to provide safety are repricing because the Fed's emergency response, whatever form it takes, will either involve liquidity injections that weaken the dollar, or it will involve tightening that breaks something else in the credit markets. The 60-40 portfolio, the balanced allocation, the diversified index strategy, all of them were built for a world where commodity prices stayed range-bound and where central banks had credibility and flexibility to manage crises without revealing systemic fragility. That world ended Monday night when silver crossed 200 and the Fed admitted it needed an emergency meeting to manage the fallout. If you rely on a paycheck, the mechanism is even more direct. Employers negotiate wages based on trailing inflation data and forward expectations that assume stability. But commodity dislocations don't wait for wage negotiations. They reprice costs immediately, and your paycheck, denominated in a currency that's being debased to fund emergency interventions, loses purchasing power faster than your salary adjustments can recover. The gap between what you earn and what you can afford widens every week the crisis persists, and the interventions designed to stabilize markets do nothing to close that gap because they're designed to protect institutions, not individuals. What smart viewers should watch in the next 48 hours is not the silver price itself. That's the outcome, not the signal. The signal is in the repo market, specifically the overnight and term repo rates, because if the Fed is preparing an emergency liquidity facility, the first sign will be unusual movements in repo pricing as banks pre-position for Fed funding. Watch the dollar index, because if Powell's response involves significant liquidity creation, the dollar weakens against other currencies and against hard assets, and that weakening accelerates the commodity repricing cycle. Watch the spreads between near-month and deferred futures contracts in silver and gold, because if those spreads widen dramatically, it means the physical shortage is getting worse, not better, and it means the intervention isn't working. Watch for any after-hours statements from the CME Group or from the Commodity Futures Trading Commission, because those statements will be the first public indication of whether the clearinghouse is preparing to modify contract terms or invoke emergency settlement procedures. And watch the Treasury yield curve, specifically the 2-year and 10-year spread, because if the Fed's intervention triggers a flight to safety or a repricing of inflation expectations, that spread will move violently, and it will tell you whether the market believes the Fed is in control or whether the market believes the Fed is improvising under pressure with no good options left. The threshold that matters most is whether silver holds above 180 by Friday's close, because if it does, the March contract delivery demands will finalize at levels that guarantee a clearinghouse crisis, regardless of what Powell announces. If silver pulls back below 160, it signals that either the shorts found a way to source physical metal, or enough longs got scared into rolling their positions forward, or the Fed's intervention leaked early and the market is pricing in a resolution before the official announcement. But if silver consolidates between 180 and 220 through Thursday, it means both sides are dug in. The longs believe they have the leverage, the shorts believe they can't afford to cover, and the Fed's decision will be the only thing that breaks the stalemate. What happens Monday morning when markets reopen will reveal more about the durability of the dollar-based commodity system than any Fed speech or economic report published in the last decade, because this isn't a theoretical stress test or a model-based scenario analysis. This is a live clearinghouse event where real institutions face real losses and real delivery obligations, and the Fed's response will either stabilize the structure or it will confirm that the structure can only hold together as long as nobody actually demands physical settlement, which is another way of saying the structure was always fragile and the confidence that held it together was always one squeeze away from shattering. The entities positioned for this, the ones holding physical metal, the ones who accumulated miners before the squeeze, the ones who understood that paper claims would eventually collide with physical scarcity, they're not watching the news for confirmation. They're watching the repo rates and the clearinghouse filings and the after-hours statements that don't get headlines, but carry all the information that matters. The entities that ignored the warnings, that stayed in cash because it felt safe, that assumed the system would never allow a commodity to dislocate this severely, they're the ones who will spend the next 6 months trying to understand what happened and why their portfolios lost purchasing power, even though the nominal values barely moved. Powell has 48 hours to choose between bad options, but the choice he makes won't fix the underlying problem. It will only decide which part of the system absorbs the loss and how visible that loss becomes to the public. The real question isn't whether the Fed can contain this crisis. The real question is what breaks next after the Fed uses the last of its credibility to contain this one. Because emergency interventions don't restore confidence, they consume it, and once the market understands that every commodity squeeze will be met with rule changes and liquidity injections and forced settlements, the incentive structure shifts permanently. The entities with hard assets stop selling them forward, the entities that need physical delivery stop trusting paper contracts, and the system that relied on the assumption that paper and physical were interchangeable discovers that the assumption was only true as long as nobody tested it. And now that it's been tested and failed, every participant recalibrates their strategy around the new reality that physical is real and paper is a claim that only gets honored when it's convenient for the system, which means it's not really a claim at all. It's just a bet that the system won't fail before you exit. 48 hours is not enough time to fix a structure that took decades to build and seconds to break, but it's exactly enough time to decide who gets told the truth and who gets handed the narrative. And if you're waiting for the narrative instead of tracking the signals, you're already on the